guess what? Last chapter, last lecture of the semester. So let's talk about retained earnings. And you guys have heard me talk about this all semester long. Retained earnings are what we grow them when we have net income. We shrink them when we pay out dividends. So you can think of it as this is all of our earnings we've retained, right? Because it's everything we've earned less everything we've given away. It always has a credit balance. Now, what happens if I just lose money all the time? Then we call the retained earnings having an accumulated deficit. It just means there's a debit balance. It's not really a contra liability or contra equity because it should have a credit balance, but it can sometimes be a debit if the company has lost money since the beginning of time. So let's look at retained earnings over 4 years, right? Year 1, the company loses money, it's negative. Year 2, they earned $3,000. They paid no dividends. Now the balance is $2,000. Now, this should look familiar to you because retained earnings is a balance sheet account. And so it's constantly updated. It doesn't reset every year like the income statement. Remember, if we put this into a T account for retained earnings, right? The first year they had $1,000 in earnings. The second year, $3,000. Fourth year, $4,000. Oh, but look, they paid $1,000 dividend. And then in year 4, they had $10,000 in earnings and a $3,000 dividend. Right, and if we did the sum of that, we would see our balance of $12,000. You can also do it in the way that they've put together and think of it as rolling forward. Right, I start the year with negative $1,000. I have income of $3,000. Well, then I end the year with $2,000. Right, so whatever we have in retained earnings at year end really comes over and is then the beginning balance. Cash dividends. So we've talked a little bit about cash dividends already. We talked about preferred dividends and arrears, etc. Remember, companies can choose to pay whatever dividend they want. They're not legally obligated to pay dividends. And many companies choose not to. Apple did not pay a dividend really until maybe 10 years ago, I think, from the time they started out. An important point to note are dividend dates. So I want to walk you through these 3 dates. Declaration date. This is the date I have to make my journal entry because I've declared to the world I'm going to pay a dividend. Okay, and on that declaration date, I'm debiting dividend, right, which is a contra equity account, and I'm crediting dividend payable. So the key to remembering that is I've declared it. Once I declare it, I need to make the entry. The record date is simply the date that our back office or the people that have to process the payments, that's the date of the people who own the shares, who's going to get the payment. So if a declaration date was October 1st, I'd make my entry October 1st. If the record date was October 15th, that would mean every shareholder that owned a share on October 15th is going to get a payment. And then the payment date is when the actual cash goes out. And that entry is going to debit the dividends payable account to clear it out, credit cash. This was important when I worked in corporate because a lot of CFOs would forget that when they declared the dividend, we had to make the entry. Sometimes they would declare it because they wanted to get that out there. They wanted to get the good news, but maybe the equity wasn't ready to take that reduction. So we would always need to remind them, hey, wait a minute, don't forget, as soon as you declare it, I have to make my entry. Oops. This is just an example of American Eagle, how when they did an announcement, they talked about the declaration date and the record date. All right, we've already shown you in the previous slide how to record it. But declaration date, I'm going to do however many shares times the dividend per share. Record a payable. Then when I actually make the payment, I'll clear out the payable and credit cash. On which date would a company record the debit to dividends? Again, declaration date. Now, stock dividends and stock splits. I'm not going to spend a ton of time talking about this. What I want you to remember is it doesn't change anything. companies can sometimes choose to split their shares or reverse split them or give stock dividends as a way to manage the number of shares outstanding. They don't do it. It does not give people any added benefit. So let me show it a little differently, right? So a stock split. Let's just say you have one share of Amazon today and it's worth $50. And Amazon declares a large stock split or stock dividend. And they say, Jennifer, instead of having one share, now you have two. I don't have two shares worth $50 anymore. The marketplace knows that there was this split, and so the marketplace has now revalued those shares to $25 each. So I had $50 before, and I have $50 today. Now this confuses a lot of people because they think, well, then why the heck do you split it? Well, sometimes companies do this because maybe their shares just get too expensive for people to buy, and so they're trying to make it more accessible or easier. If we looked up Netflix right now, I know Netflix has gone through a lot of splits because every time their shares get up in the $700 or $800 per share trading range, they want to make it more accessible, so they split it. Right, and again, no real change. It's the same pie, we're just slicing it up differently with stock splits and stock dividends. That's your only takeaway. All right, so let's talk about reporting stockholders' equity. You guys should be so good at this by now because I forced you to do the statement of stockholders' equity on every single exam. So remember, the stockholders' equity in the balance sheet, that's just always those accounts at that point in time, same as the rest of the balance sheet. Whereas the statement of stockholders' equity is taking the reader from the beginning of the period to the end of the period. So a balance sheet would have the equity accounts listed on it, whereas the statement of stockholders' equity would show our readers how we got from the beginning of the year to the end of the year on those same accounts. You guys have done this, again, all year. So here are some of the different concepts we added in this chapter. We've been issuing common stock all semester. Now we're showing issuance of preferred stock, repurchase of treasury stocks. We've got a new column here. Sale of treasury stock, dividends, although you guys have been dealing with that this semester, and then net income. So let me cover one last concept before I close out this lecture, and that's earnings per share. Now, earnings per share, we don't have to do accounting to come up with earnings per share because accounting has already driven the net income, or hopefully it's net income and not a net loss. Well, that net income is going to mean very different things depending on how many shares of stock are outstanding to each shareholder. So if I have net income, and again, we have to take out any dividends on preferred stock. If I have only 10 shares of common stock outstanding, well, that earnings per share number is going to be much higher than if I have 1 million shares of common stock outstanding. So you hear in press releases, you see in a lot of finance-related articles, people talk about earnings per share because that is saying, here's how much of the earnings you as the shareholder are entitled to. Now, let's pause for a second. Will you actually get it? Depends what the company's philosophy is on dividends. But again, it's just a good metric to understand how the company is performing. All right, I'm going to do this final exercise with you guys so that you can practice all of the concepts that we've gone through, and then we'll close it out. Okay, so let's put together our statement of stockholders' equity with all of the things that happen. We were given the beginning balances. We issue 60,000 shares of dollar par value for $50 a share. And so they got cash of $3 million. We increased common stock and we increased paid-in capital again because we had that par to deal with. So we can put that both in journal entry form and into our statement of stockholders' equity. Next, we repurchased 10,000 shares at $58. Well, we know we don't have to deal with paid-in capital when we're purchasing the treasury shares. We're simply debiting treasury stock, crediting cash. We can show that on our statement of stockholders' equity in our new column for treasury stock. Oh, I had net income. That's always a good thing. So what am I going to increase? I'm going to increase that retained earnings. And I've declared a dividend. Ooh, declare. Okay, good to know. Declared means that I have to record something. Here's a big hint. I'm never going to pay myself a dividend. I might own my own stock, but I don't pay myself a dividend. So I only pay the dividend on the number of shares that are outstanding, right? Because we had 150 shares at the beginning, we issued 60, we repurchased 10,000. That's 200,000 shares times $1 per share. Let's put that down here on our statement of stockholders' equity. So net income increased it, dividend decreased it. And lastly, I reissued 5,000 of treasury shares for $62. Well, to do this entry, I have to remember how much I put it into treasury stock. Well, I put it into treasury stock at a different price. Let's see, let me finish that up. So I've got to take it out at the same price of what I paid for it. So the $290,000, balance the entry with additional paid in capital. Let's see if it'll give us the totals down here, and it does. So now I can total it up, and those are the numbers I see on the balance sheet. You know you've done it right if those numbers tie back to what's sitting on the balance sheet. And again, this is just a partial balance sheet, but you can see, yep, they come right over. Total stockholders' equity of 11.93, total on the balance sheet of 11.93. All right, so, we won't get to play the game. All right, guys, this is the end of chapter 10. Again, probably the last time we'll talk in virtual form. Definitely come see me next fall. And good luck on the final.